Good morning, folks, and a very warm welcome to the final 10-minute market forecast of the year. My name's Jordan, and I'm a strategic business manager here at Blackfinch. And today I'm joined by our product specialist, Josh Clayton. For those of us who are joining us for the first time, or those who maybe need a little bit of a reminder, what we look to do on this webinar is to give you some very short sound bites with what's going on in markets currently you can take with you with the client meetings to inform hopefully any questions that you may be encountering in current climates. I'm going to keep things short and snappy today because there's plenty of Josh to cover. What we're looking to cover today is going to be naturally the US election. More importantly, obviously, how the markets have reacted to the news that Trump will be coming back into office. Equally, we're looking at French politics, what's going on in the economy, and what it could mean for the wider Eurozone. So, Josh, I think it's best to hand over to you so you can get stuck in.
Good morning, Jordan, and thank you very much. And to everyone else today, an early Merry Christmas from myself and the multi-asset investment team. Now, as Jordan's already touched on, there's no better place for us to start than the US and the aftermath of the election. Now, I'm going to touch on the news itself and some key points on what Trump may look to do with his new position and what this could mean over the coming months, but really into 2025 and beyond. So firstly, the election. As we all know by now, Trump's successfully maneuvered his way back into the White House for a second term, and his win, combined with a Republican red sweep of the US Congress, puts Trump in a very strong position to start implementing his economic and political agenda as early as 2025. The scale of his win has come as a surprise to many, including myself, and his campaign proposal seemed very broad-brushed. So I think at this stage, it's almost too early for us to try and assess how these policies may play out. But he's made it clear that trade tariffs, immigration control, regulatory easing, and tax cuts are all going to be the priority. Now, there were clear winners and losers that stem from the election. And what mattered for investors was being a part of the Trump trade. And that is the collection of assets that would move significantly in favor of the promises he's made. And shortly after, the market reaction was one of a strengthening dollar, higher US government bond yields. And when I say that, I mean borrowing costs as a rule of thumb, and both rising Bitcoin and stock markets. And these are all telltale parts of this Trump trade. He was very outspoken on the stock market and rising in this manner during his first term, and he associated it with his administration. And actually, you can argue that his term were partly responsible for such a strong and prosperous US market, because it was largely attributed to that Jobs Act that let Trump cut the corporate tax rate from 35 to 21%. And that in turn boosted profits for companies. And we've seen some strong trading updates over the years. So with all of that in mind, I'll just touch on one of the key points for us to consider as investors, which has just been all over the headlines, and that's his trade tariffs. Now, I did mention this in the previous webinar, but just to reinforce it, Trump coming into power can mean some near-term volatility for markets, and we've seen it over the last week or so. And this was off the back of a post he made to his social media site, Truth Social. And he stated last Monday that he planned to quickly impose 25% tariffs from Mexico and Canada, and an additional 10% tariff on imports from China. And then when trading opened the next day, shares of Ford and General Motors fell sharply on the news, I think with General Motors down about 9% for the day. And this is all concerns over the automaker's heavy reliance on this cross-border trade with Canada and Mexico. However, looking away from that, even with it all going on, the broader market just shook off the news. The S&P 500 continued its march. I think at the time it was the 7th consecutive session, and it marked like its strongest winning streak in over 2 months. But on that day, importantly, Trump appointed a famous Wall Street hedge fund manager, Scott Bessent, as his Treasury Secretary, which was a very positive move for markets. Now, this man is thought to bring a Wall Street mindset to the seat, and he could prioritize economic stability and inflation control with a very measured approach to tariffs. So it's a pragmatic mind that's being brought on board, and markets really like him being there, as he could be a calming presence in the White House, and he can help stave off any insensible policies that Trump may propose. And actually, just on that sharp bit of volatility off the back of his post, there was a lot of noise from high-ranking officials and people close to him that these very heavy and bold claims were being used as a negotiation tool rather than having real merit. And it does seem like a very blunt and direct form of negotiation tactics, and it almost feels akin to Trump waving around a big heavy stick, but not actually wanting to swing and use it. But the key takeaway is yes, there may be this kind of near term volatility, but the US market as a whole appears quite strong and can offer investors a protectionist stance as the economy continues to grow and companies perform well. There is an argument to be made on what type of US company may perform well going forward. Is it going to be the same Magnificent Seven, or are we actually going to need to take a more active approach to picking companies, quality companies that could be further down the market cap scale? And current valuations are much more attractive in relative terms when you're comparing it to Trump's first term. So if you're just looking at the S&P 400 as an example, so your mid caps, away from those top 100 companies that we know so well, or the S&P 600, which is your small caps, there are very good quality names that you can pick up rather than having to buy very expensive large caps at this stage in the cycle. And this is where active management can really come into its own rather than you just buying the market through a passive vehicle. Now, while the US market is having its moment in the sun and performing well, France's prospects have started to darken somewhat, and the country's sadly been making the wrong kind of headlines. Now, if you follow this series, I mentioned 6 months ago about the snap election called by President Macron off the back of some dismal election results prior to that. And the drama's continued where the current parliament is divided roughly into three equal blocks. So Macron's group, his rival Le Pen, plus a left-wing coalition. Now, it took Macron until September to appoint a prime minister, and that's Michel Barnier. And he spent 3 months trying to come up with a budget that's going to gain a majority and start to reel in France's worryingly indebted finances. However, Le Pen has come out fighting and caused gridlock over the budget. She said the government are unwilling to negotiate, and she's therefore unwilling to support the budget unless there's a big turnaround by the prime minister. She's got to be quite careful because she's going to want to avoid being painted as the person who brought on a crisis, because the French economy at the moment is in a very difficult position and the French stock market reflects it. It's been very clear, clear as day almost, that France is underperforming the rest of Europe. But because the economy is so large, there's an argument that this may have a knock-on effect or cause some contagion. But it's too early to say at that moment. But the other clear indicator that the economy is struggling is shown in its bond market. French bonds now yield more than those of Spain, meaning that investors think they need to be compensated for the extra risk to lend to France in comparison to Spain. And you can take it one step further, and if you look at Greek yields, there's no gap whatsoever between Greek and French bonds, and it's showing faint echoes of levels not seen since the Eurozone's debt crisis. So to summarize, we think it's important to keep an eye out for France at the moment and what contagion there may or may not be with the rest of the Eurozone. If we see a rolling over on the budget, it would imply that further increase in France's debt as a share of GDP and borrowing costs could balloon further, and the ECB may need to step in to buy bonds to help. So political risk is really weighing on the French economy right now, as the government finances are in a bit of a mess and they can't agree on this budget. So again, the Eurozone should be an area of focus for investors to ensure we're selecting the right kind of company, and longer term if French stocks can recover after the government comes to this agreement. Now, I'm conscious of time here, so I thought I'd just cover some of the data points that also made headlines to be aware of. The first is inflation. US inflation was in line with expectations. It shows it's finally under control, but it's not out for the count. With Trump coming back into power, inflationary concerns are back on the table. So that's US CPI or PCE. They're going to be measures we need to be mindful of, and is certainly something that the Fed is going to be watching closely. The 11th of December marks US CPI, and there's a forecasted tick up from 2.6 to 2.7%. And even though this is a tick up, it looks like markets are still pricing in the Fed lowering interest rates by 0.25%. There is an acknowledgement that the current monetary policy stance is quite restrictive, so look out for that decision on the 18th of December. UK CPI was the next one that grabbed headlines. There was a jump from 1.7 to 2.3%, But this was largely expected due to that off-gem price cap coming off. So it didn't cause too much volatility. It didn't rock the boat too much. And similar to the Fed, markets are pricing in another 0.25% interest rate cut from the Bank of England, and that's the day after on the 19th of December. The Eurozone also have an interest rate decision slightly earlier on the 12th. Again, another 0.25%. So we can see holistically, there is an acknowledgement that inflation's come down from its historic highs and it's within a more manageable level. So we're likely to see this slow and steady pattern of minor interest rate cuts over 2025, unless something else comes in too material to change that prospect. Some other events to be mindful of, in particular, employment data for the regions is going to give some insight into the current health of the respective economies. We're also coming to a close on corporate earnings for Q4. We've seen the majority of earnings come through, but there are still some in the likes of financials and tech that are due to report. And sometimes these larger players can affect their own sector due to the size, so that is something to be mindful of. And then, as always, the year end, it comes with lower trading volumes during the holiday season, and that comes with its own risks and opportunities. Now, we had the Santa Claus rally last year, and I think this is something for us to watch out again in that week run up to Christmas and in between the holiday periods. So do keep an eye out for that. But Jordan, that's everything from me. So just a quick thank you for tuning in over 2024. It's been great to have you along for the ride here. And I definitely hope to see you all next year. So over to you, Jordan, for the wrap up.
Thank you, Josh. And yeah, looking to echo your sentiment. Thank you, folks, very much for joining us today. We hope you found it really useful. And of course, if you've got any feedback or questions on aspects we have or may not have covered today, then be our guest and write into us via strategicteam@blackfinch.com. Now, next market forecast is obviously due then to take place in the new year, which is going to be on the 7th of January at the same time of 10 to 9. Until then, we'd like to wish you all a very pleasant festive season with your friends and family. We look forward to seeing you in 2025. Take care now.